Hey traders, Dr. Barry Burns here with Top Dog Trading. Today we're celebrating the holidays. I'm actually recording this on Christmas Eve 2013. And so to fit the theme of the day, I thought I would show you the Christmas technique. And this is primarily for day trading and for day trading equities of some sort, whether you're trading individual stocks or equity indexes. And this is not something that I created. This is a well-known technique, or at least fairly well known, but there's probably some of you out there who haven't seen this, so I thought I'd share it with you. One of the things that we want to do at the beginning of each day and continually monitor throughout the day of trading is to determine the overall energy of the market. What's the overall condition? And what I mean by that is to look at several things and help them to help us determine whether we expect the market to just be on a complete tear to the upside, a raging bull market today, or a raging bear market today, or whether we expect things to just be mixed and for the market to kind of meander sideways. And the reason that's so important is to help us determine on a daily basis how far we expect our trades to go. So, for example, let's say we're taking a trend trade and we get into a trend. We want some sort of indication as to whether we expect that trend to be extended, to go 3 waves, 5 waves, 7 waves, 9 waves, 11 waves, whatever. And when I speak of waves, by the way, I don't use Elliott wave anymore. I have my own way of measuring waves that's very objective. But the basic principle is, when we get into a trend trade, how far do we expect that trend to go? Because there are days, I call them unidirectional days, when you could pretty much just buy on the open and exit at the close. Stay in all day and make a ton of money that way. Other days, the market's kind of choppy, and so we can still get little trends within a choppy market on a smaller time frame, though. We have to go down to a smaller time frame. And we can find short little trends that might only last for 3 waves. Now again, not talking about Elliott waves, so when I do my wave count, I'm not insisting that it makes 5 waves every time. But let's just refer to it as short trends, short-lived trends, or longer trends. And this becomes very important because when it comes to money management, hey, if we have an indication that this market is very, very dominant to the upside today, and we expect it to just continually move up in the big picture and the big scale of things, continue to move up with maybe some small retraces to the other direction, then we're going to do a couple of things. Number one, we'll stay in that trade longer. Number two, we'll use looser stops. And even when we get a little downtrend going on the chart, we'll use that as an opportunity for a reversal trade, back going long in the direction of the dominant energy of the overall market. And that's when reversal trades have their highest probability. So it all goes toward reward. How to determine how long we should stay in a trade, how big of a reward we expect today, things like that. So anyway, there's several techniques that I use for that. Here's just one of them. And this again is called the Christmas technique, and it's called that because it colors our indexes green and red, which are the colors of Christmas. So now you can use various industries and sectors and so forth, but you want a variety is the point. You want quite a variety. So I put the descriptions up here. You're welcome to pause the video and write these down if you want to. On the left, as you can see, this is TradeStation. So on the left are the TradeStation symbols. Those may vary depending on who you're using as your broker in your data feed and so forth. But just as a quick example here, what we're looking at is just a real general idea of how many of these sectors are green and how many are red. So in this case, most of them are obviously green, but we still have quite a few red ones. The more that it gets closer to 50-50 red and green, the more we would expect a meandering sideways market, non-trending. And obviously, when red overcomes green, then we say, okay, the energy is a little more to the downside. On unidirectional days, what you'll see is that almost all, or sometimes all of these, will be green in an uptrend. And it's those days that we say, wow, that's great. Obviously, the dominant energy in the overall stock market is up. Everything's up today. And we're pretty much looking for longs. And even on short-term time frames, as I said, when we get downtrends, we look to take those as reversals to go long, trading against the short-term trend back in the direction of the dominant market. So it's kind of a big picture. It's not meant to be used alone. Again, the key is to use a variety of sectors. Now, one more thing that's very important, and that is when you choose which market you want to use, whether you want to use these or some others, you can use indexes, which usually have a dollar sign before them, or you can use exchange-traded funds or ETNs, which are actually tradable. But there are some things that we don't expect will always move along in concert with the equity market. So let's say that today we had mostly green, which we do. Then we'd want to look at the red and we want to analyze, okay, now which markets are red? So, for example, if it's bonds, okay, well then red bonds, that's fine. That doesn't matter because the bonds in the equity markets often are uncorrelated. So we're not going to worry about that too much. What else do we have down here? Well, that's about it. All the rest matter. Okay. So, for example, tobacco, biotech, broker-dealers. See, that's a key one. The fact, if it's going to be a very bullish market, you pretty much want broker-dealers to be bullish that day. This is a real warning sign that broker-dealers is red. And the general idea is that a bullish market is good for the brokers because then they make more money, more people are enthused about trading. Agriculture, again, it's commodities. Now, so many stocks are affected by commodities, so it's still important. Healthcare is certainly important. Biotech certainly important. International markets, that can vary. Again, it's good to see them in line with the U.S. equity markets, but sometimes they can diverge. Consumer staples and services and so forth. Silver. Now, this is another example. So things like silver or gold. If the whole market is green, but silver and gold are red, in other words, if either one of those or bonds are red down here, we don't care that much because they will often trade in an uncorrelated direction to the equity market. Sometimes they trade with it, sometimes they don't. But if those are red, we don't care. That's fine. Let's see if there's any others here that I would point out. Oil, that's an interesting one. That can vary too a bit, but still, so many things are dependent on oil these days. But even like silver, silver too, I don't want to completely discount that because silver is used in so many things that a lot of these companies make, the manufacturers make, and companies sell, and products that companies use. So it still plays in. But in and of itself, it's a commodity. But then if it's cheap, that can actually help companies by lowering their costs. So there's many, you could really get into some intricate analysis of this if you wanted to. I don't think it's worth getting into that type of intricate analysis because you can get analysis paralysis and you're never going to really figure out all that's going on. And remember, it's only one day. It's only one day. So we're just basically looking at the big picture. Is this market dominantly green or dominantly red? This one is not dominantly either because you've got some important markets down here like biotech, healthcare, very important for the economy, agriculture, broker-dealers, like I said. I got biotech in here twice. I don't really need to do that. I could take one of those out. One's an index and one's exchange-traded fund. Yeah, and then bonds are down here. So this is pretty much a mixed market. We would consider it not to be a strong market, but a little more to the bullish side than bearish side. Now, last thing, the other thing that I do is I go up here and I put the 4 major equity markets in cash, and then I also look at their futures. So, got the Russell 2000, Dow Jones, S&P 500, NASDAQ 100. These are the 4 major market indexes I watch. So I look at their cash indexes and I look at the futures. Both. Why? Because there are times when you will have for example, the NASDAQ 100 might be green on the cash index and it might be red on the futures index. Yeah, I've seen it. So we call that a bifurcated market. And really, these 4 rows here are the primary ones I look at first. If there's any mixture of red and green here, then we don't consider it a unidirectional day. Then we're always going to be cautious. I'm going to be looking to take profits sooner. That's really the practical point here. Am I looking to take profits sooner, or am I going to let my winners run more today? So, and then the last thing that we look at is the percentages over here. I don't care what the values are. I'm looking at the net percentage change. So when we get very low percentages like 0.18, 0.10, that's so close to 0 that it might as well be 0. And I don't consider it to be super significant until it gets to 1%. None of the equity markets this day made it up to 1%. Okay, now when we go down to some of our sectors, we did. Okay, so metals and mining, base minerals, oil services, basic materials, steel. So those are really your 4 bullish markets today. And then we had 1 bearish market, which was the REITs, the Vanguard REITs. All the rest, you'll notice, are not... There we go. Did not reach 1%. So the vast majority of them, whether red or green, did not make it up to 1%, which again, till it gets to 1%, they don't consider it to be committed to the upside or committed to the downside. It could turn at any time. And of course, that's in concert with the famous saying that the market can do anything at any time. So, even with this, obviously, even if everything's real bullish one day and you say, okay, great, we're off to the races, I'm going to let my winners run, always be aware, one last caveat, one last warning, the market can do anything at any time. Just because at any snapshot in time you have a dramatically bullish market, still always use your money management techniques, always use your hedging, always use your risk management techniques, because as we've all probably seen, or at least many of us have seen, I've been trading for decades, so I've seen it over and over and over, something can come across the news wire. It can be dramatic news about the economy, either here or abroad. It can be a terrorist attack, God forbid, or war, or any number of things. And when those surprise announcements come across the newswire, all bets are off. Everything, the market doesn't care what your candlestick patterns are, your Fibonacci levels, your RSI, your CCI, your moving averages, your elemental Ps. It's just going to dramatically respond to dramatic news. And everything can change in a second. So, all of this is to say, watch the big picture, but always, always, always filter this and maintain caution and use your risk management, your money management, and your hedging.